Hey, how's it going, everybody? Harrison George here. I had an awesome time going to visit Chris Noggle. We had a wonderful podcast. Just wanted to let you guys know that if you have any questions, feel free to reach down below in the description. Again, check out this video. Really appreciated Chris giving us some of his time. Talk to you guys soon. Statistically, you will not be in a home for more than 10 years.
See, the banks are so smart.
The banks win all the time.
It was one of the smartest moves I could have ever made, because you have to understand it's not about the interest rate, it's about the velocity of the money. What's going on, everybody? Chris Noggle back with the Money School podcast, and you know what this podcast is about. It's about you taking back control of your money by you being your own bank. But today we're going to mix it up. We're going to talk about something near and dear to most families' hearts, and that is their house. That's right, the house you live in. Now, there's something unique that's happened over the last almost 10 years, and that is your house has done nothing but go up in value. While their house has gone up in value, so too have interest rates. And as interest rates have gone up, what that has created is this unique period of time where people are sitting on tons of equity locked in the walls of their house. That is until today. Because today, my guest, George Harrison from CMG, is going to show you how to unlock all that lazy money sitting in your walls, and then how to use that money to create wealth out of your own debts and expenses. Because I know for a fact, most Americans are sitting on lots of debt. How do I know that? Well, I got a little magic ball that tells me, I'm just kidding, statistics show me that credit card debt is out of control, car loan debt's out of control. So let me just paint this picture before I introduce my guest. What would it be like if you could create wealth through the debts you already have by just taking back the money you're giving away? Yeah, what about that? Sounds pretty good. You wouldn't have to work harder, work longer, or take on any additional risk. All we'd have to do is use that hidden equity locked in your walls. Well, that's what we're going to be talking about. So I am really excited to introduce my guest today, one of the Beatles, George Harrison.
Beautiful. Thank you so much for having me on here, Chris. Really appreciate that. To correct you a little bit, my name is Harrison George. However, most of the people that I talk to never really get my name proper. My middle name's Paul, last name's George, first name's Harrison. People think I'm related to or named after the Beatles. Normally, they just end up calling me Ringo, so we can just leave it at that. But my name's Harrison George. So nice to meet you guys. Thank you for having me on here.
All right. Sorry to bust your bubble. We don't have one of the Beatles here, but you know what? The next best thing is the person that can show you how to get the equity in the walls of your house out to use it to pay off your debts and all sorts of things. So let's dive into this, Harrison. Like, your company does something very unique in the industry. There's only a few companies that I've come across that do what you do, but you guys have been doing it for a long time. So just to get started, let's just talk a little bit about CMG and talk about what it is you guys do and what you specialize in.
Yeah, so we actually are a mortgage company. We're fully operational in all 50 states, and we actually have been doing loans, obviously, since 1993, which is when we were founded. This first position line of credit is new to the United States in terms of, I guess, the world knowing of the first position line of credit. Very, very popular in Europe and Australia. They're actually called sweep or offset accounts over there. Interest rates over in Australia are in the teens, and this is the largest product that is utilized down there for home acquisitions. The CEO of our company went down there for a conference, learned about the product, and said, this is completely different than how we do it in the United States. In fact, I need to figure out how I can get it here. So he pioneered it towards the end of 2005, 2006 timeframe. It was the first lien HELOC in the United States. It used to be called something different, called the Homeownership Accelerator. They changed that around because the initials were HOA, which is like an association for your house. So it got a little confusing. But this product is something for the right person that can substantially change the direction of their life without changing how they approach their finances.
So let me just kind of unpack that a little bit. Your mortgage most certainly is probably a 30-year amortized loan. And what you should probably all know is you should all read the small print on your mortgage, but let me just tell you what it says. In the first early years of your mortgage, usually the first 7 to 10 years in an amortized mortgage, the majority of your monthly mortgage payment is going to interest, almost all of it. For some of you, it's 80%, some of you, it's 85%. But just think about that. Every payment you make for the period of roughly about 7 years, I'll let you correct me, but about 7 years is all going to interest. So very little of your principal is being paid down. In a first lien HELOC, is that what we're going to call it?
Yeah.
Okay. In a first lien HELOC, what you're doing is you're paying simple interest. Now, you'd really have to understand the difference between amortized and simple interest, but let me just put it to you this way. It gives you back control because now you can take and pay payments to your first lien HELOC and knock that principal down a lot quicker while having access to a lot more of the money. Now, what they've pioneered is actually pretty revolutionary from what I've seen because I have a first lien HELOC. As a matter of fact, I just did it. And my first lien HELOC gave me all the equity out of my house. But here's the thing. I went from about a 4% interest rate to close to an 8% interest rate. How many of you think that was a smart move for me? I went from a 4%, 30-year amortized loan to about 8% in a first lien HELOC. Was that a smart or dumb move? I know what they're all saying. They're all saying it was stupid.
I disagree.
Exactly. It was one of the smartest moves I could have ever made because you have to understand it's not about the interest rate, it's about the velocity of the money. So do you want to explain that a little bit as why the interest rate shouldn't be the biggest focus here and how the money is used?
Yeah, so it's not always about interest rate. It's about interest cost. So you said it takes about 7 years, or in the first 7 years or so, you pay more towards interest than you do towards principal. That's actually more like 12 to 18. I know. The lower your interest rate, sure, you could be 13 or 14%, 13 or 14 years. If you're higher in the interest rate, 6.5, 7, you're working towards the later half of almost 2 decades. The interesting part in the 30-year amortized loans is that super fast math. At a 5.625 interest rate, you spend 100% of what you borrow in interest. So if you have a 5.625, by today's standards, rates are in the mid-sixes right now. At 5.625, a good interest rate today, you're going to spend 100% of what you borrow in interest. So if you have a $400,000 loan on your home, you will spend $400,000 in interest over the life of the loan. But in the first 5 years, so less than a quarter of the time in the loan, you'll spend 25 to 27% of total interest in just the first 5 years. Statistically, you will not be in a home for more than 10 years.
Exactly. See, the banks are so smart.
So the banks win all the time. And if there's a way for you to be your own bank and or figure out a way of eliminating your debt so the bank can't get a hold of all of your extra money that you're working so hard for, you can begin to utilize that to advance your life, whether that means you need to retire in 10 years, or that means you want to retire early, or you want your wife who just had your third kid to not need to work because it's cheaper for you to have your wife stay at home instead of pay for childcare. And it's smarter to have your wife at home and take care of your children. There are these everyday problems that can be solved by just dealing with the delayed gratification. I don't need to get the new car right now. I can work on paying off some of the debt that I have and work on paying down the balance of my home, because in these first lien HELOCs, we'll get into it a little more in a bit, but you only make payments on what you owe. So as that balance goes down, your payment goes down with it. The way that my wife and I talk about it is, great, once we have our home paid off, we're going to slowly phase her out from working so that she can take care of children, which hopefully one day we're going to have. And inevitably, that means that because the payment's going down, we're not needing to utilize her income to supplement that payment that we have on our home at the moment.
So think about it this way. If you make a principal payment on your 30-year amortized loan, your normal mortgage, does your payment go down? Like if you paid $10,000 down on your mortgage because you got a bonus or a windfall of money, and you dump it on your principal, you're still making the same exact monthly payment. But in a first lien HELOC, if I dump 10 grand down on my mortgage, that principal just went down 10,000. So now the bank is charging me the 8% on $10,000 less. And every time I make a principal payment, or every time my principal's paid down, that interest goes down. So this is the whole point of it. But there's a whole other side of this that we're going to dive into. And this is the most fascinating thing, because some of you are like, I'm still not picking this up or understanding this. You'll understand this. I want you to look at all the debt that you have right now. I want you to add up all your credit cards. I want you to add up all of your car loans in your household. And let's just start with that. How much does that amount? 1,000, 2,000, 3,000? Some of you are driving some nice cars. Think about that. Every month that you work hard, you're giving all of that money to the banks, and you're never getting that money back. Your car will depreciate in value. Your credit cards, well, they are what they are. But imagine now you go in and you refinance your house and you do a first lien HELOC, like what Harrison's company does. You pull the equity of your house out. So that lazy money that was trapped in the walls, you now have that money. But you got to be diligent about this, so pay attention. You take that equity and you pay off all of your debts, starting with the lowest balance to the highest balance. They call that the snowball. And once you pay all those debts off, here's what you do. You take the exact same amount. This takes a little bit of practice, not much. You just got to condition yourself and get your mindset around it. You take every payment you used to give to the car loan finance companies and the credit cards, and you then put all that money back into the first lien HELOC. So you repay the same source where you took the money. Now, does everybody understand what's happening there? You no longer have any debt because the equity that was trapped in your house now paid off all your debt. And you're taking the exact payments that you used to give to your debtors, which is not changing your cash flow in your household, and you're taking that money and you're putting it back toward the mortgage, the first lien HELOC, which then is velocity is reducing that mortgage down. Did I hit that right?
Yeah, I mean, so you said a couple things that I'm going to throw some corrections in there. So technically in a 30-year mortgage, not a VA loan, but technically you can do something called a recast. And a recast essentially is where if you take $10,000 or more and apply it to your 30-year mortgage, your 30-year amortized mortgage, you can pay $200, $150 as a one-time fee to say, I want you to recalculate my payment based off this new balance. Now, sure, that's great. Your payment might change by $50. You lose access to all of that money. That $10,000 could have gone towards, like you said, paying off debt, which might have actually had more of a benefit for you. And in many instances, the second you put that money into a 30-year mortgage, I'm making an extra $100 a month payment towards my home. That's great. You're throwing away that money into something that's going to cost you money to access it again. And access it every time you want to access it, it will continue to cost you money. So as you utilize, like you said, this loan to pay off other debt and you pay that balance down, I kind of like to think of it as if I had a money market and my money's sitting in a money market account and there's $50,000 sitting in that account and it's earning me 5%. Well, you're going to get taxed on that money. And that money may be actually taxed at 20 or 30%. Well, if you took that $50,000 and stuck it against a debt that's costing you 8%, you're saving 8%. So a penny saved is better than a penny earned because this 5% is really more like 3.5%, and the 8% is like making 8% because you're not paying taxes on the money you're not paying in interest. Hopefully that makes sense.
It does, but there's one other thing too. Like if I make a principal payment, if I take the money that I used to give to the debts and I make that payment back over to my first lien HELOC, because I have one of these. So remember, I can think of this real time. And I do that. That money, if I pay principal down, is immediately available to be used over again. Correct. If you make a principal payment, even if you recast it on your current mortgage, that money's not available. You lost liquidity of that money. You lost control of that money. In this system, in the first lien HELOC system, when you make principal payments, that money is again available because you're just replenishing the line of credit. So now you can take that money and you can do things like invest it. You can buy real estate, whatever floats your boat, whatever you know, like, and understand. That's the difference. So if you could just let your imagination go a little bit and get past just paying off debt and start thinking about if you were to recapture all of the money that you give to your debts into one source, that money then became available again, what would you do then? Well, I could think of something they should do.
And so to kind of take your point even a little further is instead of taking the money that you would have paid towards those debts, let's almost take a step back. Put every dollar you earn towards that first lien HELOC, towards the line of
So 100% of my income goes into the first lien HELOC.
Correct.
Because it's just like a bank account. Actually, it is a bank account.
Exactly. So you have direct deposit. You have auto pay, bill pay. You can link up your other bank accounts in case you say, gosh, I need $1,000 because I'm going to go buy a lawnmower from my neighbor and he doesn't have Venmo. I just transfer it into my Wells Fargo, go to Wells Fargo later that day, pull it out, go to my neighbor and say, here's the cash. Now, yes, you do get a debit card. I shredded mine because I want to use the bank's free money while they're giving me free money for 30 days. I want to get the points by going to get a hamburger. Instead of saying, oh, here's my debit card, let me have my mortgage balance go up by $5.99 for buying a hamburger. Instead, when I can delay the payoff and have my balance remain $5.99 lower for 25 days. Now, sure, it saves me a couple of pennies, but pennies add up.
So what you're saying is it's all one place where the money goes. So instead of me taking a paycheck or a bonus or anything and putting it into a bank account, then making a payment down on my mortgage, my first lien HELOC, what they're doing is they've combined it all. Mm-hmm. When you take your paycheck and you put it into your bank account, that actually is paying down the mortgage.
Correct. Yeah. So it's partially why
over time, that's making it so the interest you're paying, the APR, is significantly less.
Correct.
But it's not changing anything in your life.
Nothing's changed at all. In fact, it's actually simpler because you earn your money. That money 100% goes into the checking account, just like any other bank account. Every night, whatever's in that checking account will get swept from the checking account.
Automatically.
11:59 every single night, Eastern Standard Time. So 11:59 for you. Essentially what happens is that your checking account goes to zero. You don't have $0 in your checking account. It's just moving it from that account number to your HELOC, the line of credit. You put 10 grand into your checking account, 11:59 comes around, your mortgage balance comes down $10,000. Midnight, your calculation is done on the balance of that loan. Now you have access to $10,000 extra dollars. Your line of credit increased by $10,000 because there's a limit on how high you can go on this. There's a bunch of information that we can kind of go into the nitty gritty on that.
But we can set up all the same bill pays. So I can set up bill pays back to my private banking systems. I can set up all my same bill pays and it all works exactly how it does today.
Exactly the same.
But every dollar is now working way harder for me because it's reducing.
Until you need to spend it. You don't change how you live your life.
But most people use credit cards throughout the month. So at the end of the month, you just pay the credit card off.
Make sure you pay it off at the end of the month. Correct. We don't want to add a new interest expense somewhere else.
Right.
And that's kind of what we're focusing on. I like to look at this loan as there's two philosophies. You have debt elimination or debt acquisition. Now, debt acquisition is probably not the right way to say it, but debt elimination is pretty simple. I have a car, I have student loans, I have credit cards, so on and so forth. Let's get rid of those. Those are each costing me money, and in many instances, the average American's paying just the interest expense on a lot of their credit cards. My minimum payment is blank. I hear it all the time. Now, debt accumulation is where I start to get a little more fascinated by it. The people that bought their home for $300,000 5, 6, 7 years ago now sees a home worth $600,000. They get access to a line of credit of 80% of the value of their home. They may owe $250 over here, but they get a line of credit of substantial amount of funds. Well, what if we use that to tactically place it somewhere that's going to earn me close enough to what it's costing me when I pull it out? I pull out $10,000, my mortgage balance on my home goes up by $57. Could I use that $10,000 deployed somewhere to give me a received funds of at least $57 a month? I would say there's plenty of opportunities across the country to do that. It doesn't need to be received. It could be the perception of value or value of future growth. I put this into a CD and that makes me X dollars. Well, does it make me more than it's costing me to have it out? Simple math.
Wow. Hopefully all of you are understanding this because it really isn't complicated. It's almost the same thing you're doing now. All of you have a bank account that you put your money into. And then from there, you pay your bills, bill pay, write checks, or you use credit cards. And then at the end of the month, you get the credit card statement, you pay the credit card, and off we go. But all the while, you have money leaking your family over and over and over again, which is depleting the amount of wealth building you can do because you're just literally living and working to pay your bills. But all the while, I'll bet most of you listening to this podcast have equity just sitting in your house because house values have skyrocketed. I'm not going to say they're going to stay up there, but for right now, as the recording of this podcast, equity is prevalent. And most people are sitting on a lot of untapped equity because they got these low interest rate mortgages, which they think are the greatest things ever.
Phenomenal.
And they won't refinance or cash out to pull the cash because like, oh, no. I'm not going to go from 3 to 6%, or where are rates today?
Mid-sixes.
Mid-sixes. Who would do that, right? Well, the person that understands what Harrison is talking about absolutely would do this. You would never, ever keep a 3% amortized mortgage when you can use the first lien system and get all that equity and wipe out either all or a majority of your debt and then take back all of the money that you're giving away. It just makes perfect logical sense.
I 100% agree, obviously.
So what do people get hung up on here? Because like I'm literally sitting here thinking, what sense in the world? Jordan, are you thinking this makes sense? Just so you all know, Jordan's the one behind the camera. But like, why wouldn't people do this? What do they get hung up on?
Well, it's not meant for everybody. So there are certain requirements for this product for it to really make sense. And that doesn't mean that it's not for everybody, meaning somebody else is automatically out. It's just there needs to be the proper steps taken into place to do this. Just like when you go and get your first car or your next car, it's okay, well, should I be doing this? Do we have enough disposable income to be paying this $400, $500, $600 a month car payment? We have certain requirements that an individual needs to meet to get into this product. Now, certainly they are a little more expansive than a 30-year mortgage, but that's because we've had zero defaults, foreclosures, bankruptcies of individuals on this product. No other product in the United States or probably any financing system can ever say that because the people that qualify for this product are overly qualified. Now, that doesn't mean that we can't build the game plan. Oh, your credit score is below the necessary credit score requirements. Great, let's put you into a path to get into this requirements. It's a way for you to build the game plan of not just your future, but your kids' future and building generational wealth. Now, yeah, like you said, property values may not always remain high. And then we can get into probably a longer discussion on inflation and how that may actually not be the case. And they're trying to solve that and tariffs this and tariffs that. But at the end of the day, it's talking to individuals and seeing what their goal is. I mean, the average person that we've communicated with over the last 12 months are probably in their late 30s, early 40s. And we're looking at these individuals who have 5, 6, 7, 8, 9 debts outside of their home and personal lines of credit that I think are phenomenal. Personal lines of credit are amazing if you pay attention to why you did it in the first place and a game plan on paying it off. HELOCs are great, unless if you decide to just make the minimum payment. So understanding that you have to be very diligent with something like this, and you can get yourself into trouble just like any financing tool. But this tool does something that no other product does. It gives you time, and none of us have an extra second of time. And what I mean by that is if you lose your job or your wife loses their job, and now you guys are having $0 come into your house, but you have a line of credit of $400,000 on your home that has a $200,000 balance, great. You don't need to make a single penny for 2, 3, 4, 5, 6, 7, 12 months, because all that happens is the expense of your life just gets added to the balance. You have $200,000 of available equity in your home that can help you weather a storm. It's what helped weather people in 2008 in this product, and it will continue to help weather storms as this product continues.
Well, offline before we were recording, you talked about a case study of a gentleman that you worked with. Can we talk about him?
Certainly.
I mean, you can't use his name, but talk about that situation was amazing.
Yeah. So recently we've closed a transaction where essentially an individual had about a $200,000 balance on their home. Now they had $500,000 or $600,000 of available equity in their home. What they didn't really mention all too much was the amount of debt that they had. They had a little over $150,000 in debt, and it was costing them something like $4,800 a month in expenses. This individual said, I'm not touching my first mortgage. I'll never pay that off. It's at a 2.9 interest rate. It's phenomenal. Great. Let's walk through what your actual blended interest is in your household. And the guy's blended interest rate was like 11.5% between cars, lines of credit, credit cards, which are astronomical right now. He had, I can't say exactly what it is, but it was over $50,000 in credit card debt. And at 30%, that sounds a heck of a lot like that's almost 10 times the amount, this, $50,000 in debt on a $200,000 loan, 30% here, 2.9 here. This is costing him just as much as this is costing him. So we discussed a game plan on helping him get his scores up with the available equity in his home, then using the first lien HELOC and building the game plan out. Hey, this is what you need to do. This is how you do it. Sure, you spend a little extra money here, But over the life of this product, in the life of those debts, you are going to save something like $2,400 a month and have your home paid off in 11 years.
Wait, so he saved $2,400 a month?
Because he took the money from his available equity, paid off all of it, put it into his mortgage balance. He then ended up having the mortgage payment be higher, but no debt over here. $4,800 here, mortgage balance went up. Payment went up on this, but the difference between his mortgage payment and the debt and his mortgage payment over here was drastically higher than what his payment was just on his home.
And a lot of people will never even, like, there's all sorts of articles about this. A lot of people will never pay off their credit card debt where they're at right now because they just can't, because they're literally stuck.
They're
stuck right now.
Digging themselves into a hole.
People are financing groceries.
I know.
But these people that are financing groceries are probably sitting on hundreds of thousands of dollars in their home, but they're like, oh, I got one of those 3% or 2.4% mortgages. I'm never paying that off, but I'm going to go bankrupt over on this other side. That makes a lot of bloody sense.
Taking loans against their 401k to pay off bills that then end up getting racked back up again. So now they not only are getting slightly less on their next paycheck because they're paying their 401k loan off, they're also now building $5,000, $6,000, $10,000, $15,000 of credit card debt. And it's okay. And sometimes it's just having the hard conversation. What are you spending your money on? Looks like you have subscriptions. Looks like you have unnecessary expenses that perhaps you can afford. Let's just get this under control. Then let's go back into it. And it's not under control of stop going to dinner and don't go to the movies for 15 years. It's, hey, can you hold off for 10, 12, 18 months on some of these other luxurious items? Yeah, great. Go get dinner with your wife. Have a date night of please. But let's figure out how to build a game plan. And sometimes it's not fun to have conversations with people of saying, you're doing all right. Here's how you can do better. What it's going to cost you is going to be a change to the next 12 months of your life.
But people have to be willing to make a change, because if they keep doing what they're doing now, they're just going to get worse and worse off. I mean, what got them here is not going to get them where they want to be.
Yeah.
So this change is just an education process. So I love that you mentioned for that client that, you made paying off his mortgage in 11 years and saving $2,400 a month, which is substantial for a lot of people. You basically built that program for them. So can we just talk about what your team does when someone wants to work with you? Like, do you do that for all your clients?
Correct, yeah.
Do you also help this credit score?
Yeah, so I'm not licensed in credit repair. I feel like I have to say that. Now, we can say, great, let's run your credit. We can run a simulation to say, oh, if you did this, this, and this on your credit, paid down debts, got a new credit card, it would give you a 90% chance to get your scores to 720. Great. They go off and do it. We do the rescore. Beautiful. Your scores are up. But on top of that, it's, there are plenty of times where we do two steps, a two-step process. They go from their 2.9 into another 30-year mortgage. They pay off debt, get scores up, because they don't have money sitting in their checking account to pay off $20,000 in debt to get their scores up. So yes, they do another transaction. We build the structure into it. We show them the math. Over the life of this loan and all of your other debts, you're going to spend X dollars in interest. Let's just use $400,000. If you were to go into this all-in-one product and you were able to get your scores and everything was great, you're only going to spend $140,000 in interest. Now, you can't do that because we have to do an intermediary step. And this isn't for everybody, by the way. This is just for certain individuals. It's going to cost you $4,000. So would you spend $144,000 to save $400,000? And
of course.
I think that the answer is yes. It's people lose the forest through the trees, or they're stepping over hundreds to pick up pennies. And it's scary at first because it's change, and not many people enjoy change.
Yeah, I agree. Nobody likes change, and a lot of people don't want to learn something new. I mean, I face that with the infinite banking concept. It's simple. It's changing one thing and adding one step, but yet a lot of people are like, that's too much. Or they get caught up in the minutia of like, oh, I heard about those things. And I'm sure there's stories of people that have abused first lien HELOC, where they've taken it out, they didn't change their lifestyle, and they just racked up more debt, and they're in even a worse place. But like, that is a behavioral issue. Like, I hate to say it, but here's your sign. What sign I mean is the sign that says I'm stupid. And I know that's none of you watching this, but like, I'm just trying to get you to understand, like, you have to be willing to change, and you have to be persistent and consistent to make this work. Same thing with the infinite banking concept. So let me go one step further to that guy, right? Now, let's just hypothetical, that gentleman you worked with, you coached him through all that, you got him set up. He saved $2,400 a month. Let's say he took that $2,400, put that into a specially designed and engineered whole life policy. Then, as that money built up, was able to use that money to go out there and invest or do whatever he needed. Now, all of that money is earning interest and dividends uninterrupted while he's able to use it to make money a second time. So now what you're doing is taking your system, okay, which is just using the equity in their house, freeing up capital over here to then put that money into a system that allows you to take back the banking functions in your life. I mean, if they did that, that would even speed the process up more, because now you've got interest and dividends compounding that then go into, well, I mean, how fast could we have paid off that gentleman's house? It probably would have been faster than 11 years.
Oh yeah. And this is there's so many little things that people go, oh, I totally get it. Oh, but I didn't think of that. What a lot of people don't understand is that as that balance comes down, your payment comes down with it. Financial advisors talk about it in buckets. Here's the bucket I can't touch. Here's the bucket I can touch. Here's all of your disposable income. Here's living expenses and mortgage payment. Well, how about we take mortgage payment from this bucket and move it into this one? If your payment comes down, if somebody's had a payment of $3,000, but in 24, 36 months, that goes down to $2,000. Well, now their expense of that $1,000 is not out in the wind. It's just sitting in their pocket. So over time, as they pay that down, their money retained every month continues to go up. Imagine figuring out a way of saying, hey, here's extra money that I can apply towards other investment vehicles that can expedite my payoff, expedite my retirement, expedite my goals.
I love that. Expedite. And back to the infinite banking concept, taking that 2,400, putting it into that specially designed whole life. You know what else that does? Make sure that if should anything ever happen to that gentleman who's the insured, the death benefit then pays off the first lien HELOC, the family, the kids, the wife. Now all of a sudden everything's paid off, and now that bucket got really big really fast. Not that we'd ever want that to happen, but just talking, hey, that's protection. It's self-completing your entire financial system.
I do have one question actually for you is, I have a policy myself, and I'm still obviously going through. I feel like I'm always a student. I always want to learn. One of the questions I've kind of been thinking about, and this kind of throwing you a little on the spot, is, does it make sense to just have one policy? Does it make sense to have two or three? Is there a difference in structure on, do I have one with a high death benefit? Do I have two with small death benefits? What is something that people can utilize?
So I think
for something like
a lot of people get caught up and they think that more is better when it comes to the policies for your private banking system, but it's really not the case. The reason you would have more policies is you set one up. Like, let's say you set yours up and that solves a specific problem. You're saving the amount of money you want to save. Then you take loans from the policy and that money goes out to work for you. Let's just say you lent the money on a real estate deal at 10%, right? So now that 10% interest is new money coming back to the policy. So let's just say you kept doing that, and you kept, as you added money to the policy, you kept using that money, sending it out to work, and it kept creating more. Eventually, you're going to have more money building up than you can put into that policy, because you can only put into the policy the premium deposits that we build it for. Mm-hmm. That's your cap for how much you can put new dollars in, and you can only repay up to the amount of the loans. But if you kept using the infinite banking concept, eventually there's going to be extra money, because as that loan paid off, that 10% loan paid off, that loan just got satisfied. What about all the interest that was paid on that loan? You can't stuff that into the policy. So now that money builds up in a bank account. And just like traditional banking, you have never driven around any town or any city and seen one branch of one particular bank. You've seen a branch office on this corner, one in that corner, one in this town, one in that town, right? Why do they have so many branches? Well, because they open a new branch so that they can raise more money, because that demographic. Well, your private banking system's the same. Eventually, as your life improves, as your income goes up, you're going to want to put more money into your bank. But if your bank only has a vault that can hold X amount of dollars, well, that's the capacity of that bank. So now we're going to add a second policy. We call it a branch office. Then that one's going to get filled up. You're going to add another one and another and another. And eventually, like me, I think I have 12 or 13. Gosh, I can't even remember. 12 or 13 on myself, 2 now on my daughter, 3 on my wife, and 2 on my mom. Wow. So you start expanding it throughout your family, and that's your private banking system. And that outlives you by a long shot. Because when I pass away, all those policies will pay a death benefit to a trust. That trust is mandated to buy policies on all the children and all the kids that are ever born into my family. That trust must buy new policies so that when they grow up and they use this system, eventually we all die. Then when they die, it refills the pot. The family banking system just keeps getting bigger.
And is there a strategy that would be utilized for the amount of that death benefit? Because my understanding is that if there's an amount that you want the death benefit to be, because more of the money that goes into the premium is available to you sooner, depending on what the premium.
So yeah, when we design the policies, each policy design that we do is around a specific need. So let's say your first need was hypothetically to pay off debt. We're going to design that policy, the most efficient design for that need of paying off debt. But let's say your next policy you do is to, invest in real estate, which is more of a long term. We might design that policy differently than the one to pay off debt.
Okay.
And then you add another policy, and that one is you're doing some estate planning. So we want to maximize the death benefit. So if we maximize the death benefit, we're going to reduce the high early cash value.
Okay.
So this policy might not have as much cash value in the early years, but it's going to have more death benefit. So you can see we can tailor every design around needs or whatever that family wants. Now, if you're trying to do all of it with one, you can. We can use term riders and things like that, but it gets muddy if you're trying. It's like there's no one widget that does everything. It doesn't slice them and dice them and chop them and grade them.
Yeah.
It's just that they have those, but do those things ever work? No.
Yeah.
So you want the best tool for that specific need. You don't want a hammer to go out there and cut your grass. You want a lawnmower, right? And that's it. You're going to buy the tool that solves the problem.
I would love to, and I'd be curious. I know
where I came up with a hammer for mowing lawn.
Yeah, I thought you were going to use scalpel for some reason.
Scalpel.
One of the questions, and we were talking about this earlier, was for those individuals that had trouble early on in their life or halfway through their life, and they had difficulties in 2008, something happened and their trajectory changed based off of some event. If those people are starting there, I want to retire when I'm 65 at 40 or at 50, 55. It'd be interesting to see, great, the average homeowner in America has $400,000 loan. I'm just making that up right now. But it would be interesting to see how can someone, through the combination of either first lien HELOCs or not, utilize these policies to build up enough cash value to pay off their debt, $400,000 loan or $500,000, make up your own number. It'd be interesting to see, is that if you need to do X amount of dollars, if you're this old, to have access to $400,000, and here's how you can do it. And with a little influence from the individual of being a little diligent over those last 10, 15 years before they want to retire. I would love to see the math on it. I don't think I've ever seen it anywhere. I'm sure that's probably going to take a couple dozen hours to do. By no means am I suggesting that you do it, but I would love to find a time to sit down and say, hey, here's a client that we worked with, a test client, if you will. This is what they have disposable every year. They save an extra $40,000 every year. If they were to use $40,000, what does that look like? And how does that change the person's life?
What's interesting, because you just made that sound so complicated.
Yeah, maybe I do.
Literally have software, proprietary software that we have created that does that. And it doesn't take weeks or even days. It takes just knowing your situation. Okay. And then we can mathematically put together the solution that does exactly what you want. In that case, if somebody wanted to retire or they wanted to pay off debt, we can tell them exactly, here's how much money you have to put in. Or we could say, okay, here's how much money you have to save today, which is more practical. And then we show them, and that's going to have this result. But if you increase that by $50 a month or $100 a month, this is the result. So literally, you can constantly change the inputs on the software to show you the outcome, and then you can dial it in. And here's the difference too, with what we're doing, we're dealing with a guaranteed product. Like the product grows on a guaranteed interest rate. So we can predict with almost certainty something far into the future, where if you try to do that with a market-based product or a stock market-based product, you're just, well, if this works this way and that works this way, this will be the result, but that probably won't happen either. So I don't know. Best of luck, pat you on the ass.
And even with just the minimums, it's possible that in 10 years, in any given instant, they could be making more than just the minimum. So
100%.
You are saying worst case scenario or best case scenario, better case scenario if there was a good 5-year run or whatever.
Well, when we build these, the one thing I don't think I say this enough, but when we build them, there's always going to be the max amount you want to save. So somebody wants to save $500 a month, right? We're going to build it to hold $500. Now, you can't put more than $500 in, but you can put lower than that. Sometimes 60, 70, 80% less. That's your threshold. That's your flexibility. So if things get rough, you just reduce the premium deposit you're putting in. Things get better, you recap it back to the 500, and then you can make up all the money that you didn't fund it during those difficult periods of time. And we do that because we know people's lives change. We know, recessions or economic, conditions change. People lose jobs. And when they do that, we don't want their whole financial plan to blow up underneath them. So you have to create that kind of flexibility in the policy business.
I just find that so fascinating.
Yeah, because you're taking what I just told you there, and you're also looking at it saying, wow, if I plug that into the first lien HELOC system,
correct,
like these two become incredibly powerful, which is one of the most fascinating things we need to dive into and really start to really look at is how do we make these two things work together to solve clients' problems?
Almost like figuring out a way of creating a product that could just do both at the same time would be so incredible.
That's just software.
Yeah.
We've already created the software. So now we just need the inputs of seeing how could this work with what you do. Listen, sky's the limit for what you can do. It just takes an imagination and a worthy idea. Earl Nightingale.
And lots of hard work.
And a lot of hard, Let's not leave out hard work, because nothing we're talking about, folks, is super easy. It's not hard, but it comes with work, diligence, and being consistent and persistent. Nothing else works without those elements put in.
Fascinating.
All right. So folks, if you're interested in learning more about this, Harrison, where can they go? I know you have a bunch of trainings and they could probably book a call with you, right? So what would that look like? Yeah.
So obviously, if you just click up here in the description, there's going to be a link for our YouTube channel, the Harrison George team. We talk about creative, responsible ways of different kinds of financing, from this all-in-one product to other really unique and responsible loan products.
So you heard that. We're going to put it up in the description. Just click the link. You can learn more. Watch some of George Harrison again, of Harrison George's videos. And from there, you're going to learn how this can really work for you. But also, one of the coolest things is we're going to keep working together, and we're going to find a way to bring first lien HELOCs together with the infinite banking concept. So stay tuned. The idea came about first right here. As we wrap this podcast, thank you for joining it. If you like it, throw me a like. But also, check out the other episodes and make sure you go on to Harrison George's and check out his YouTube channel. With that being said, thanks for joining us for this episode of the Money School Podcast. We'll see you next time.